From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Good afternoon, this is the COB, all the stuff you need to know about the day in business and markets. My name is Kyle Rodder. Let's get a check on where the market is tracking with, well, an hour left in the trading year, the financial year, of course. And, we are flat as attack, it would seem, going into the final hour of trade. A little bit of a dip at the start of proceedings, but nevertheless, it's been basically flatlining ever since then. And, let's get a little bit of a look on, the three themes as I've identified them today. And first and foremost, the theme that is really catching our attention is, a flat finish. We've just mentioned that, but it wasn't so bad. The last 12 months, or at least financial year 2022, 2023, a 9.5% increase in the ASX 200, not even including dividends. So it's been a pretty wild ride, quite naturally. Interest rate fears, as well as, a recession that just doesn't seem to eventuate, no matter how much we talk about it, could all still come to pass naturally. But for the time being, it has been a decent year for stocks. And we will pick up this topic in just a moment's time. But countdown to the RBA. If you do look at rates markets at the moment, basically a 50-50 chance that the RBA hikes again next week at its July meeting, taking the cash rate to 4.35%. But I want to get straight into the stock of the day now. And of course, Link Administration was in the news after losing a key contract with superannuation fund Hesta. To give a view on the stock and, whether it's a buy, hold or sell, June Velu from Tribeca, as well as Adam Dawes from Shaw & Partners, joined, our special host, Amber Sherlock, on giving their view about Link Administration.
Link is too early to touch. I would say it's a sell. The margin it's been charging has to come down. And clearly, with this move, it's going to shake in the future forecast for many other contracts. Look, it is very cheap, but it's perhaps your capital is better elsewhere.
Certainly, Link has been really, really tough lately. And I guess anything in administration is obviously going to be a little bit tougher. But Link's share price over the last 12 months is down about 50%. So, it's really... It's really been a horrible sort of year for Lincoln. Probably one that they want to put behind them. Certainly Pexa was another one of those deals that they did but didn't actually go through. And then they've got some issues also in the UK with some fund managers, and I don't know if that has been sorted out as well. So I'm agreeing with Junbei. I think it's a sell, and I would put money elsewhere. I think that's probably the best call.
Put money elsewhere. I think that's a pretty good way to sum it up, at least the views there about Link Administration. Of course, down quite considerably today, off by around 0.5%. And just getting onto that news specifically, it was because supergiant Hesta dropped its contract with the company to provide fund administration services. It's going to switch to Grow Inc. So the impact is expected to be a $48 million hole in group revenue in FY25. Hesta plans to transition out by the second quarter of FY25. Link Group has still reaffirmed its guidance for this year, and it's still paying for last year's data breach too. And you can see there over the last 12 months, the stock down by 56%. Okay, and in further news, Medibank still in the headlines. The health insurer provider confirmed another class action claim. This action comes from shareholders who allege the company engaged in misleading or deceptive conduct, and that Medibank breached its continuous disclosure obligations by not telling investors about deficiencies in its cybersecurity systems. Also, Bubs Australia, it's axed its plan to produce infant formula in China for the Chinese market. The ex-factory sales under Bubs' exclusive China distribution arrangements are still below expectations and continue to disappoint. Plus, holding a significant amount of inventory will set the company back between $20 and $25 million. That'll be a non-cash impairment. Its net revenue for the full year has coming from the Asian country is expected to be at the lower end of the previous forecast. Downer EDI was also in the news. It has achieved contractual close on the $4.6 billion Queensland train manufacturing program. Downer will design, manufacture and commission 65 six-car passenger trains which will be manufactured in Queensland. Chief Executive Peter Tompkins said the project is one of the critical links for South East Queensland's public transport system for the 2032 Brisbane Olympic and Paralympic Games. And that was the corporate news. Let's get to the bigger picture and, the week that was as well, maybe the week and even year ahead. Shane Oliver from AMP Capital is standing by. Shane, thank you so much for joining us. With all, I suppose, the concern about obviously rate rises, the impact it has on the real economy, we have seen actually a reasonable financial year for equities overall.
That's right. I think it would have surprised many people going back a year ago that markets would do so well. And don't forget, a year ago, we had a pretty rough trot through the end of June, early July. We got those very high inflation numbers released in the US, and markets were fearing the worst. And of course, it continued fairly rough out to October. But 9.5% is a pretty good upswing in the market, particularly once you add the dividends. You're up around 14%. I think the key in all of this has been that the economy has probably proven a bit more resilient than might have been feared. We've also seen, and I think this is adding to confidence, we've also seen, I think, a clear downswing in inflation globally. It's not just the US, but virtually most countries you look at seem to have passed the peak. And that provides markets with confidence that central banks are getting close to the top. So even though they still talk hawkish, as long as that downtrend in inflation continues, then markets sort of know that, well, sooner or later we're going to reach the top, and there's a good chance that hopefully we'll avoid a recession. That said, I guess the question mark is whether it can continue. I tend to think we're probably still in for a rougher trot sometime in the next couple of months. Those recession risks remain high, very high in Australia's case. And the markets are somewhat overbought and probably due for a decent pullback. And we have that rough patch out to September that you normally see. But on a 12-month horizon, I suspect that ultimately falling inflation and eventually falling interest rates will help markets see another positive year. Maybe not as strong as they have been over the last 12 months, but nevertheless another positive year, albeit with a few bumps along the way.
Indeed. Okay. So I really wanted to get your view on Wednesday's CPI numbers, especially, of course, they will inform in some part the RBA decision that comes Tuesday afternoon. You have this obviously sort of two sides of the argument. One, that headline figure came down, well, more than expected. But there's those signals that as well, stripping out volatile items, there's a stickiness to inflation in the country. I mean, how did you see the data? How do you see the inflation pulse, generally speaking, at the moment?
Well, I thought it was good news. There's no way you can say that it's not. 5.6% is much lower than had been expected, and there's clear downtrends in prices, categories across the board. Whether it's clothing, which has gone negative, furnishings, the petrol price decline, food price inflation looks to have peaked. Travel and accommodation looks to have rolled over. Home building expenses look to be slowing down. So those things all, I think, are unambiguously positive, and they do continue the downtrend. But as you say, it's on the one hand this, on the other hand that. If you take out a few items in there and look at the services side, there are still risks in the CPI. Obviously, rents, meals out and takeaway. We know that utilities, electricity and gas are still going to go up from here, and that's probably what the Reserve Bank will be more focused on rather than the downtrend in that headline number, which is why we think, I must admit, it's a very close call, and I've waxed and waned on this one. I personally think the Reserve Bank has done enough. I think they should pause for an extended period, but I'd have to say that the risk is, and this is our base case, that they will hike again on Tuesday. And if not on Tuesday, then probably again in August. So it's a difficult call, but I do worry that when you look around the world, virtually everywhere except the UK is seeing much better than expected inflation numbers on the downside. And that tells me that central banks are getting it under control and they should be pausing for a lengthy period rather than talking about further rate hikes. But I'm not a central banker right now. And the reality is that central banks are still hawkish, and that includes the RBA.
So, I mean, a note that you released recently ascribed, and correct me if I'm wrong, a 50-50 chance of a recession in Australia. Of course, in the spirit of looking ahead to the next 12 months. I mean, is that the kind of risk that we're talking about, that we could enter some, at least technical recession this financial year?
That's right. Obviously, we're not there yet. I think if it were to eventuate, and as I say, it's 50-50 chance, it would be either later this year or early next year. As you pointed out in the introduction here, these recession fears keep getting pushed out. They're still there. I guess we should know that from history, that it often takes a long time, or takes longer than expected for monetary policy to impact. But I think that is the big risk for the next 12 months, that we do slide into recession. Economic data has a history of being okay until it's not. You saw that through the GF, or in the run up to the GFC in relation to the US. People seem to be fine with their debts, and then suddenly they weren't. A similar story in Australia in the late 1980s, that we were fine with higher interest rates until suddenly we weren't. And it's hard to know what precisely causes that trigger at the end of the day. But the reality is we have seen significant monetary tightening that is causing a lot of pain for the household sector. We are seeing tightening lending standards, particularly in the US, and ultimately these things do run the risk that they knock us into recession. So I think that's a key factor to keep an eye on for the next 12 months. If we didn't have the aggressive moves by the RBA, then I'd be far less concerned about that. But the RBA, along with other central banks, remain quite hawkish, and they've gone further than I would have thought.
And last but not least, the most important question at all, are you modelling a significant jump in inflation around the March quarter next year as Swiftflation bites by any chance?
No, I'm not. I'm currently feeling very depressed because I missed out on tickets, both in the pre-sales and also today. So that hasn't worked out too well, but I guess that's life. Only 650,000 tickets in total there, which means a lot of Australians were going to miss out. But I think it is quite conceivable. You will see a lift to travel accommodation in around February next year when those events occur in both Melbourne and Sydney. But I don't know that will be enough. I don't think that will be enough to affect the March quarter numbers as a whole. And I certainly don't think it will be enough for the Reserve Bank to justify doing anything on the back of it. I think it would be a temporary phenomenon, and it would be a 1 month wonder in the great scheme of things. So yes, there will be some sort of lift there, like there was with Beyonce, I think, in Sweden, but I don't think it will be enough for most people to notice it, at least in the surrounding months, even though trying to get to Sydney or Melbourne in time for those concerts may mean you're going to have to pay a bit more for that, and to get back home again, same thing.
Well, I'm sorry that you weren't able to get tickets, Shane. Perhaps we can throw our own Swift party around February next year. Maybe even in the office, we'll see how we go.
That's
but I've run over time. Really appreciate your insights. Have a wonderful weekend. Dr. Shane Oliver from A&P Capital.
Thanks, Carl. Take care.
Okay, well, I'm only eating into the last call now, so we'll wrap it up there. But stick around. As we like to say around here, grab a beer, grab a wine. We've got a great hour of television coming up next.